Good morning, you've tuned in to Buy Now, Sell Now. I'm Karunya Rao. With me is Varun Hiramath. We're in the final leg of the earnings season for Q3 FY21. Let's touch base with the management of BPCL joining us to talk about their numbers and the growth plans and targets. All right, so let's welcome in Mr. N. Vijayagopal. He's the Director of Finance at BPCL. Mr. Vijayagopal, thank you so much for touching base this morning. Can you start by explaining the exceptional expenses this quarter because of employee stock purchase during Q3?
We had a ESPS scheme which was rolled out in the year 2020 by reserving 2% of our paid-up capital to be offered at a discount to our employees. The total amount of discount, if all the employees were to accept what was offered, will be around 1,000 crores. We have decided, as per the accounting requirements, to actually absorb in the profit and loss account in a certain manner. The amount that has been absorbed in this quarter is about 420 crores for ESPS. That has been shown as an exceptional item, and the balance amount will be absorbed. First, a portion of this was already absorbed in the quarter 2. And the balance will be absorbed. It will be about 500 crores in the last quarter.
All right. And how much support from forex fluctuation, if you could tell us about that as well?
It was not a very significant number. It was about 76 crores in the quarter.
Right, sir, and coming to refining margins, had any element of inventory gains kicked in this quarter? And how are the marketing margins as well? And have operations come back to pre-COVID levels?
The marketing margins continue to be at the same levels of the quarter 2 at a normalized level. We had exceptionally large marketing margins in the first quarter. We are now stabilized at quarter 2 levels. And going forward, we expect the same trend to continue. Quarter 3 numbers, profits were actually, there was a big impact on account of the inventory gains. It was there. All of us had inventory gains because the prices were moving up from October to December, and that is reflected in the inventory gains. Coming to the crack spreads in the quarter 3 were very depressed numbers, and it was suffering around. It was actually speaking, if you want the numbers, MS cracks declined from $8.19 in Q3 of financial year 2020 to just about $2.97 in Q3 of this current year. And SSC cracks declined from $15.4 last year quarter 3 to just over $4.34 to a barrel. So the cracks were very bad, but January numbers are slightly promising. Slight improvement we see in the crack spreads in Jan.
Right, sir. And you know, there's been a very sharp spike in crude oil prices lately. We've gone above $60 a barrel. Do you think this is perhaps a spike we're seeing in the near term due to a demand increase, or do you see it as a more sustainable move upward back to where oil was perhaps before COVID kicked in last year?
We really do not know how the crude prices move up, but we are not actually affected by the crude price movements to an extent that it affects the company in the upstream side. Our profits are primarily driven by the crack spreads. But $60 we feel is a very comfortable level for us in terms of working capital management and such things. We feel that $55-60 will be a sustainable level for crude oil in the medium term.
And if you could tell us, how is the progress on the divestment front? Have you given access to the data room yet to potential investors?
Actually, for NRL, we have given access to the data room to the potential bidder, Oil India, and the consortium of Oil India and Engineers India. And the deal is expected to close very soon. Maybe it can happen even in this financial year. As far as BPCL's data room is concerned, we are ready with the data room. We are awaiting the transaction advisor to announce the names or announce the qualified bidders who have access to data room. We are ready with the data room. All preparations have been made, and our draft SPA has been cleared at the IMG level. it is going to CGD. So things are happening very fast on that side.
Yeah. Okay, Mr. Vijayagopal, pleasure chatting with you, and thank you so much for speaking to us about a host of issues, including, of course, your Q3 performance. The stock of BPCL up 1.5% as we speak. But it's not just that. We have several other managements and very important and interesting ones lined up later on the show. Turn to the markets and see how they're faring. You have Nifty as well as Sensex in firm fettle. Nifty has gained about 100 points. Sensex is up 305 points as we speak. Broader markets trying to catch up with the up move seen on the benchmarks, with mid-cap as well as small-cap index up about 0.5% each. Advance decline ratio clearly in the favor of advances, about 40 stocks gaining on the Nifty 50 index with 10 stocks in the red. As far as sectors are concerned, you have Nifty Auto witnessing some amount of profit taking after the stellar run-up it's seen in the past. Nifty Media and Pharma Index also trading a bit sluggish in trade. But on the flip side, what's aiding the market up move? Once again, it's the PSU banks up 1.5%. Nifty Bank has gained close to 250 points as we speak. You also have Nifty IT gaining about 1% as we speak. Asian Paints top gainer on the benchmark, 3.5% up. You have ONGC up 3.5% as well. The likes of Wipro, HDFC Life, SBI Life, Titan, IOC, Hindalco, UPL, these are essentially the names from the benchmark index which are gaining quite smartly. We have Kunal Bothra and Rajesh Agarwal both join us on the show today. Good morning, gentlemen. Kunal, first to you for your high and or low risk ideas.
Good morning, in Karunya. I would suggest a couple of buy calls, and the focus is again a mix of mid caps and large cap names. So the first one which I'm suggesting is about tin plate. Now, apparently the stock in just the last 10-15 minutes, before I'd given the call, has moved up significantly higher. But I still believe that the stock has a lot of room on the upside. There are some classical inverse trend shoulder and technical patterns getting breached for a stock like tin plate. So I would suggest this as a buy. It's not a high risk idea, but it's more of a moderate risk trade which I'm suggesting. So a buy with a target which could be revised to upwards of 200 rupees on tin plate, and stop loss could be tailed high to almost 166, 167, looking at the surge in the current price. And the second one which I'm suggesting is about SBI. Now, apparently this stock which has done exceptionally well from the PSU banking pack, I think looks still very strong from current levels at 400 plus or minus 5-7 rupee range. The stock is consolidating, but generally what happens is after such a strong move, if the stock remains in a tight band of consolidation, it generally results into a continuation breakout on the upside. So I'm expecting the same move for SBI in the near term as well. So buy with a target of 424. Stop loss could be kept at 386.
Okay, thanks for that, Kunal. Let's get a move on and get going with our queries for this morning. We have three. First one from Harsh Mehta of Mumbai. He'd like to invest in ultramarine pigments at current market price. So Kunal, technically, of course, we know it's a small cap stock, but it is highly coveted. Recently, a big investor, Marcellus, has also entered this name. So technically, anything you'd like to flag off for us?
Not really, Varun. I don't track the stock, to be very frank, it's also, I think, not listed on the NSE as well, if I'm not wrong. So I don't track the stock, so won't offer my comments on the same.
Fair enough. Rajesh isn't with us to help us evaluate the fundamentals of this company. Let's just move on to our next query, which is from Devan Shah, and he's looking at a much larger chemical company, PI Industries. ET Now just did a news break minutes ago about an interesting acquisition PI is looking at. But Kunal, on the charts, where do you think we stand with the PI? Can we enter now, wait for correction, or add on dips? What's your strategy here?
I think it's an excellent chart, PI Industries. I do track the stock quite closely, and I think it's been a phenomenal, I would say, and a consistent gainer over the long term. You look at the charts, I think in the last 7-8 years, I think from 2014 or 2013 somewhere, when the stock was 200 or 100 odd rupees, from there on, we've seen some significant movement coming into the stock prices on the long-term basis. And the best part about the stock like PI Industries on charts at least is the way in which the stock has moved up higher. So typically, a classic trending stock moves into short bursts of momentum and then slight prolonged periods of consolidation where it tends to absorb a lot of the short-term choppiness and try and dish out the weaker hands and then move up higher and start a new range altogether. So when you have these range shift behaviors into the stock prices, it results into classic signs of trend. PI Industries is one stock which has shown such kind of a movement. In fact, on the very, very near-term charts as well, the stock has corrected from 2,600 or 2,650 as a high to now at 2,200 odd levels. So I think it's a good level where you can look to start, averaging at current levels, or if you're looking to buy, then you can start buying at current levels. But the only concern is that this stock would require a lot of patience. So if you're in for the long haul, then I think buying PI Industries starting from current levels and then averaging at every major dips which you get along the way should be a very good strategy.
Okay, query number 3 then. We have an email from Vikram Singh based in New Delhi. He's bought 300 shares of SBI at 320 rupees a piece and wants to know if he should stay put or book profits. Kunal, I mean, there was a time when 320 was also an ambitious level and an ambitious target for a stock like SBI. Who would have thought it would trade firmly at 400 odd levels? But going by the pattern, what would be your advice for someone who entered at 320 level?
See, I think it's a very apt question now that SBI is again coming back into the league of the top banking names. So I believe that this is a very apt time to ask this question. And this is what typically happens into stock prices, which show some classic signs of chart patterns. Now 320, 340 for SBI apparently, and then 350 approximately, was a major multi-year resistance. The stock took almost 10 years to try and break past about this major resistance. Now you are talking of a chart which is broken past a 10-year high, and some resistance breakout for a stock like SBI. Now, those kind of charts were last seen in somewhere in 2017 when Reliance also did the same, when it broke out of a multi-year consolidation, breaking almost a 10 or 11-year high at 550 levels, and rest is history for Reliance Industries. We've seen the stock moving up 4% high, 4x higher in the last 4-5 years. So I think a similar kind of a chart pattern is shaping up for SBI. This seems to be a very big breakout for the stock price, and the way the stock has entered this breakout at this about this 350 mark is something which is very commendable. So I for one believe that SBI should be one of the large cap names. It should be a part of portfolios, even though the stock has just recently moved up higher in the last 1 week or so.
Sure. Thanks, Kunal, for that. And it's always great getting in your perspective on host of stocks and indices. Thank you so much for joining us once again. Slipping into a break here. Like I said, more management interactions and some interesting stories lined up when we come back. Stay tuned.
Hi, welcome back to Buy Now, Sell Now. You're watching ET Now. We're joined by the management of Jindal Stainless. Anurag Mantri, the group CFO, is now with us. Good morning, sir. Thanks for taking out the time to talk to us here on ET Now. Of course, it's been a very good quarter for you. Margin expansion, good growth in top line. So could you talk about the factors that have really aided your enhanced realizations in the quarter gone by?
I think the two major development which we targeted just before COVID and within time, that helped us really to reach to this stage. So let me just strategically the two major development which we took just before COVID by end of FY20. One was that increasing our capacity through debottlenecking by 35% to reach from 0.8 to 1.1, which we completed just a fraction of just cost of just 40 crore of rupees. So when we entered the COVID phase, we were actually with the enhanced capacity, which actually gave us the economies of scale as soon as the market took a V-shaped recovery. The second thing which we did we completed on the 4th of March, as you may recall, the CDR exit. And also we prepaid 800 crore rupees of convertible which were sitting in our balance sheet and had a huge overhang on our profitability in terms of the various charges, which we the scheduled date was actually October, but we were well within time to complete this transaction just 10 days before the lockdown started on the 4th of March. That helped us to give a very strong balance sheet and to face the challenges on Q1 of the entire production decline. And as soon as we saw a quarter two onward, the good economic recovery and V-shaped recovery in the various sectors, especially the three segments which contributed us. One was auto, pipe and tube, and industrial fabrications. And this demand was across both from rural area centers as well as the urban center. That helped us to immediately capitalize the capacity increase which we targeted and increase our volumes. So with that, and also last 1 year we took various operational efficiencies measures, especially the revamping of entire supply chain, which has brought down our cost and made us very cost efficient. All this factor put together led us to a good capturing the good volume on the market recovery and capturing the good margins on terms of the cost of economies of scale, operational efficiency through various factors.
Okay, all right. The budget, the one that was announced last week, revoked the ADD and CVD on stainless steel. So if you could tell us how, if at all, and how does that impact you?
Yeah, so overall, I think the budget was very growth oriented and it really put focuses on the segments which can help us to grow in the right direction, because that's really good from the government side to push these things. However, for as a stainless steel industry, there was one measure which was put up in a good faith, but I think would have a some of the negative impact, especially on the industry too, because they have opened up this through this CVD and this removing the CVD and ADD measures. This will open up a probably floodgate for China and Indonesia, which we have seen in the past. So we have seen both, especially both the Chinese players operate from these two countries. And we have seen in the past, they kept flooding the market at a very irrational pricing. That kills the domestic industry. We still being across the various dates, we will still be able to make up some of the partial, to mitigate some partially to this. However, if you see the 30% plus industries is still contributed by MSME. For them, it will not be possible to continue the manufacturing, and that would have a detrimental impact on the Make in India effort, on the employment, and they will become trader. So I think this was because till the time imports remain rational, we are perfectly fine. But we have seen in the past the Chinese companies' behavior, which they continue to have a irrational dumping in the country. So we are hopeful that at least the DGTR and all the other major ministries will take care of this in the future. And we are hopeful that it should be reversed soon to make the really Atmanirbhar Bharat vision a success, because we are committed to further increase our capacities and also to cater to the domestic market in a larger way. And this is what especially the MSME segment, which still contributes 30% of stainless steel producing side, more than 30%, that will be very badly impacted on through this.
Right, sir. And then what's the outlook on pricing? Obviously, right now, demand is far exceeding supply. And of course, imports are something that still, might or might not happen in the near to middle term. So what is the outlook on pricing, at least for the next quarter? Is it looking robust to you?
We'll have to, again, as I mentioned, that we have seen some of the very irrational pricing happen and below cost pricing happen through very subsidized way. So if you see that CVD and ADD, all are these are put up after a long investigation of 12 to 18 months with the complete backup of data. So we have seen these producers irrationally dumping, and India becoming as a residual dumping ground, because most of the European and US economies have put ban on Chinese and Indonesian manufacturer. And India being one of the largest growing sector, they may again start dumping at very low prices in that. That may have some of the challenges in terms of our margins and pricing also, even because we are still not even at a normalized industry levels of the pricing. Having said that, I think we'll have to watch carefully on this development. But overall, on the operational side, we have, and balance sheet side, we have made our company very robust in terms of to take some of these challenges. But as I mentioned, I think to have a sustainable recovery of the industry, it is necessary that we don't have the Chinese and Indonesian imports dumped on the country.
Right. Mr. Mantri, before we let you go, just want to get in one last comment from you. There's clearly a fair amount of demand upsurge for stainless steel. Now that you're out of CDR and have wiggle room, will you consider expanding capacity to grab this demand spot and sort of stem imports perhaps?
Surely. So as I mentioned that last year itself in calendar and end of FY20, we increased by 35% through debottlenecking. And Odisha has a very large complex. It has been kept in mind. The entire infrastructure has been built in mind to keep almost 3 million ton of the capacity. So and this expansion can be built at a fraction of cost, because this will be a brownfield expansion. So we just need to add few of the equipment. So with just one third or one fourth of the normal capex cost, we can actually double the capacity in Odisha, and which we are targeting. So with just 2,500 to 3,000 crore, we can actually double the capacity in Odisha and more cater to the Atmanirbhar Bharat dream of the government. Also, having said that, I think it is very necessary that, because our balance sheet wise also what we have done, we have prepaid most of the next year installment. So that also cash flow wise gives us a good headroom without getting into any large leveraging position to cater to this expansion. So we are working on this and to double the capacity at a fraction of the normal capex cost.
Right, so thank you so much for sharing the outlook with us this morning. It was great to get perspective from you, and clearly it's been a very robust quarter, and the outlook for Jindal Stainless remains very positive going forward. Thank you so much for joining in, Mr. Mantri, Group CFO of Jindal Stainless. With that, we're almost ready for a break, but before we go there, India's largest agrochemical company by value, PI Industries, is looking at an exciting acquisition. Sources have told ET Now that In-Swift Laboratories may be up for acquisition. My colleague Ajaya Sharma, who broke this story, is now joining in to get us the fine print on this transaction. Over to you, Ajaya.
Well, that's correct. We are gathering from our sources that another buyout transaction in the healthcare space is happening, particularly the pharma API space, which is buzzing with activity. A lot of private equity money is coming in, and there's a lot of inquiries about such assets of API. We understand that this time it's one of the largest agrochemical companies, PI Industries, which has stated in the past of its ambitions of foraying into pharma API space, is in active discussions right now with the promoters of In-Swift Labs for promoter stake purchase. Now remember, In-Swift Lab, which is actually a company which operates globally in the pharma API space, and it's got 6 manufacturing sites. Promoters are holding 42% stake there, and it got into trouble because of huge debt, close to 1,000 crore debt. PI Industries, meanwhile, one of the largest companies, is very flush with liquidity after 2,000 crore QIP, which they recently raised, and they discussed their ambitions of going into the pharma API space, both by building their own business as well as the buyout strategy. In fact, just last year, Mayank Singhal did, right after the QIP, discuss this strategy with us. In fact, the street also liked this strategy of theirs, and the QIP, which is a 2,000 crore QIP, got subscribed many times, 6-7 times were the kind of subscription. So that is the direction PI Industries is taking, and active discussions are on for negotiations regarding the valuation, etc. We understand that Jefferies is the advisor to this transaction. So when we did reach out to both the parties, In-Swift as well as PI Industries, regarding this query of ours, they did not really respond to our queries. But we understand that active discussions are happening, and PI Industries, this one of course is there on their block, but there are a few other areas also which they are looking at.
Thanks, Ajay, for that. It's time to touch base with Nisaba Godrej, Chairperson and MD at Godrej Consumer, to understand how Q3 panned out for the company and what's the way forward. Nisaba, thank you so much for joining us this morning. Can you start with telling us what the demand trends are and what you witnessed, especially during the quarter gone by? And have there been any specific changes in consumer behavior as we move back to normalcy?
So I think we've had a second good quarter of double-digit growth. I think what we're seeing are that overall consumption trends are positive. If you look at Nielsen numbers, they're saying that FMCG is growing at 5%, which is definitely quite positive. We're also seeing urban picking up. So what we saw, say, in quarter one or quarter two was that rural growth was very high. And urban was much lower, but now we're seeing urban also pick up. E-commerce continues to scale very fast. Modern trade is back in quarter three, so we're seeing that as a difference. We're also seeing an extremely strong demand for hygiene and health-related products. So I know there's a lot of news out there about how sanitizer sales, were very high in quarter one and then they sort of tanked. But I think that's one product we're talking about. So actually what we're seeing is that, the world, India has had this sort of masterclass in immunity and health, and we're seeing very high growth there. For example, we have a non-mosquito portfolio, cockroaches and rats, and nothing very glamorous, but we're seeing extremely high growth in that. And we're seeing quite big shifts in penetration in some of those categories. We've seen it in hand wash. So anything that's health related, a lot of those trends continue. And lastly, I think we had a good union budget. So, I'm quite hopeful that actually as vaccinations roll out and we get into this, I don't know if there'll ever be a post-COVID world because I don't think it's going away completely. But perhaps India's economy is going to be more resilient post 2020 than it was before. So we should look at strong demand going forward.
Let's talk about some near to medium term headwinds as well. Raw material prices, as we all know, have gone up, especially things like palm oil. Can you tell us how sustainable are your margins going forward and how are you looking to mitigate the impact of such factors?
I think what we've seen is 35 to 40% increase in palm oil, and which is a key raw material for us in soap. There is a positive to this, and we have been through this cycle many times before. I think the positive is that the smaller players, brands, tend to fall out of the market because they cannot play their sort of low price game during this time, and with very good micro-marketing initiatives, we're able to gain market shares and then sustain them in the long run. So I think that's one of the positives. Obviously, the negative is pressure on margins. And as you can imagine, you cannot pass on 40% commodity price increases to your consumer. But I think, like I said, we've been through this cycle many times before. We take calibrated price increases. We do price pack architectures. We've always actually found these cycles to be positive for us in the long run. On the margin part, we mitigated through sort of strong cost saving programs and leveraging, other parts of our portfolio and our global portfolio. So, we're quite confident about margins, but overall, I think, as we go forward, we're really prioritizing growth right now. Even if it comes a bit at the expense of margins.
Hi Nisaba, this is Varun Hirimath also joining into the conversation. Since you mentioned that some portion of the RM increase can be passed on, will you be looking at more price hikes during the quarter? They may not be for the full amount, but partially. Would you be able to give us some guidance on that?
Like I said, we will do calibrated price increases. Obviously, I can't exactly share what we will do, but I think this is a cycle that the larger soap players have been through before, and we tend to do quite well in these cycles actually.
Right. And high growth has been seen to moderate during this quarter. So do you see the growth sustaining at current levels? And what is the driving force in the high segment?
So actually, I actually expected our HI growth, especially given what happened in quarter one, to be higher than they have been actually in quarter two and quarter three. We had steady growth in quarter three. And if I can tell you broadly, what we're seeing is that this health effect is happening. People are more concerned about health. We've seen a lot of penetration gains in this category this year. Like I said, the non-mosquito category has been, this has been one of the fastest growing years for it. Most of our portfolio is actually quite premium, which is the aerosols and the electrics. That's actually growing, strong double digits. So where we're really having an issue is in burning formats. We've talked about these illegal incense sticks. I think that piece is something that, at least as a company, we've not fully pushed back on, although we do have good plans on that. So I think from a health perspective, I think that trend is there. And if you look at some of the growth pivots we've talked about, like this non-mosquito or personal repellent, penetration is very low. So the opportunity now is in these low penetration categories to drive penetration, and this masterclass in health has been given by the world, correct? So I think it makes our job a little bit easier going forward.
Okay, let's also talk about the hair color segment. The revenue growth there seems to be back on track. So are you back to pre-COVID levels? And if you could give us some color on that.
Growth has been very strong. We're gaining market share. All the formats seem to be doing really well. And I think, we've seen this actually in Africa also with our hair care portfolio. These things sort of really took a big nosedive during lockdowns, where as soon as people started going out, they want to look good, they want to feel good. So I think these discretionary categories, seem to have come back. I think we still have to, we're still going through COVID. The signs are all positive now in India and on vaccinations. I hope the demand will continue, but I would still be a little bit cautious to see what's happened, because we've seen very different categories play differently across the quarters.
Okay, let's also talk about the rural part of the business or rural exposure. Are you seeing any market share gains given the resilience that we've seen in rural demand and given the consumer focus on branded products even in the hinterlands?
I can't give you exact market shares, but we have gained market shares. We were just talking about hair colors. We've gained market share there. I think also what we did is, in quarter one or quarter four of last year, we pulled back A&P spends, correct? Because we weren't even able to supply. I think what we're doing, like say in hair color, we were actually started spending quite heavily in quarter two. That's why we're seeing these sort of market share gains. So I think the advantage will be to more established players, especially in this inflationary commodity prices. And I think the FMCG industry in whole is showing quite a lot of aggression, as you can see in sort of increased A&P spends.
Right, Isaba, thanks so much for sharing the outlook with us post those Q3 numbers. Look forward to catching up with you next time post the Q4 results. On that note, I think it's time for a quick break on Buy Now, Sell Now. Stay tuned. We'll be back in just a minute.